Fine. Welcome to the second session of this annual sessions of Sri Lanka Energy Managers Association. The next presentation is about strategic, financial and legal aspects of introducing LNG to new markets. The presentation is by Mr. Ruchit Kandage. Let me introduce Mr. Ruchit. And Mr. Ruchit Kandage is an experienced finance expert with a strong track record in leading finance teams of prestigious multinational companies. He's an expert in developing corporate finance strategies, business plans, financial modeling, etc. He has earned his professional qualifications from CPA Australia, SLEMA UK, and an MBA from London Business School and Chicago Booth School of Business. He has earned project financing qualifications from Harvard Business School of USA. He is a former Chief Operating Officer and Lead Transactions Advisor of the National Agency for Public-Private Partnerships of the Ministry of Finance. He has been a member of the Petroleum Resources Development Committee, which is the apex body for commercializing hydrocarbon resources in Sri Lanka. So, Mr. Ruchit Kandage.
You want to see the notes?
Yeah. Thank you. Hello, everyone. Good morning. I'm Ruchit, and I first of all want to thank the Sri Lanka Energy Managers Association for giving me an opportunity to come here and make this presentation. And I'm very happy for a second reason, because the previous speakers who spoke on various aspects pertaining to the CB's proposals, then on the technical aspects, and Salia spoke of the commercialization and the global LNG markets. And all of us have one common theme running in, that is what I will also say to a great extent, but I will be tilting more towards the strategic, financial, and the commercial legal aspects of introducing LNG to a country like ours. Since I'm not a qualified lawyer, I may not be able to express my opinions in legal things, legal aspects in a much clearer or in an in-depth way. So please bear with me, and the others, of course, we can discuss in depth if you require. And yeah, so the topic is strategic, financial, and legal aspects of introducing LNG and a business case for Sri Lanka. So what is the strategic intent of introducing LNG to Sri Lanka? So first of all, we touched on by one of the previous speakers. The first is enhance the energy security, where I am diversifying the energy mix by introducing a new fuel type to the Sri Lankan energy mix. The second thing, which is more important, is to have a feedstock, new feedstock being brought to nurture the downstream industry structures of Sri Lanka. Specifically, if you have a natural gas or a liquefied natural gas, when it is regasified, it's regasified natural gas, that could be used as a feedstock to many, many industries, specifically in the petrochemicals, fertilizer, bunkering, transport, city gas, and many industries. Why do we want to do that? Because that will create a lot of employment opportunities. Second, given that our geostrategic location and also the availability of natural resources, this feedstock is an ideal way of monetizing our natural endowments, right? Then what is the, why do we need to do this is also to attract much needed investments to monetize our hydrocarbon reserves. Now, many of the previous speakers spoke that there's substantial quantity of natural gas as well as other hydrocarbon resources in Manakori Basin, and in particular Block 2 and M2 block. When I was at the PRDC, what we wanted was to do a bid round and to attract large number of investors to this. when you want to monetize this type of hydrocarbon fields, we require significant investments. The investments are north of $1.5 billion. In order for us to attract that much of investments to this country, we need to have a very, very good commercial and a financial basis for such investments to flow in. So how do we do that? If you have many downstream opportunities in the power, in the fertilizer, in other offshore bunkering and other industries, that will allow any investor who's coming in to align their risk and the reward relationship along this hydrocarbon value chain. So hydrocarbon value chain has upstream, so which is basically production of assets and exploration and production. And we also know that it is fraught with a lot of risk. 1 out of 7 wells only succeed in producing. So 6 wells go bust. And that is very, very expensive proposition. So if you are to come to a virgin basin like ours and to invest large amount of money, they also have to see that there is significant opportunities for them to reap their investments and returns by investing in the downstream opportunities. So this is one of the key aspects why we want to have LNG in our country. And third, and finally, reduce cost. I think Rohan addressed that very, very clearly. Yes, we will have that. There will be a significant reduction in the cost. Then I wanted to touch upon when you are looking to introduce LNG, the very first thing what you have to see is whether we have a natural gas demand. Now, if there is no demand for this type of things, then it's no point in addressing. The second thing is that if you are not clearly identify the demand and that is not matched with the energy supply or the LNG supply, then there will be a significant mismatches, which is extremely expensive, because most of the time these LNG contracts or procurement contracts are based on take or pay, not take and pay. So therefore, if you do not pay, you have significant penalties. And it goes same for the pipeline as well as the terminal, because terminal also will be based, if it's on a PPP basis, that means there has to be minimum guaranteed payments. I will touch upon what that entails in future slides. Then you have to decide what are the economic forecasts. That is, for example, if the power plants alternate fuel, like say it's heavy fuel or diesel, is an oil product, then then delivered LNG price would have to be competitive with the prevailing price of the alternate fuel. What I mean is, if it's by introducing LNG and if you are not going to get a significant economic benefit, then we should not do that. Then the next question you have to ask is, it should be a land-based or floating structures, because in the previous part or the larger part of the history of LNG business, most of the regasification unit have been land-based. And then you also have to understand whether what type of floating storage is required. It's FSRU, which is a regasification unit, or if it's a FSP plus a regasification onshore, or whether it's a regasification and a power plant built together. So we have to do some analysis to understand what is the requirement of ours before we come and decide, yes, we want FSRU. That analysis, I believe, is already done by CB. And then you have to also think of the regulatory framework. Who is the regulator for this? If there are price increases are going to happen, who will do that? Who will approve that? What type of price increases are allowed? If there are disputes, the minor disputes, who will settle? What should be the approach? Those things also needs to be discussed and understood at this level when you are developing the project. Then if you have decided to go in for FSRU, it is a good solution. Why? There are a number of advantages, specifically for a country like ours. One is the flexibility, since it can be relocated if it is no longer needed. So therefore, if we are to monetize our hydrocarbons, that is specifically natural gas is found and they are in commercial quantities, if we can sell it, then there is no reason why we should have FSRU also. Then we should have a way of realigning and sort of re-sending this FSRU strip to somewhere else. So that is one thing. Then the bridge function, which is allowing them to import and build the local infrastructure. By having this FSRU, it will allow, as I said earlier, to nurture our downstream industries, which is quite important if you were to attract large amount of money to monetize our hydrocarbons found in Mana Basin. Other thing is it's quick compared to the other land-based terminals. We can do that very quickly, and the carriers are LNG carriers are available that could be quickly converted into a FSRU ships. And the other thing is it's cheaper than going in for a land-based one. It will be anything below $500 million for a thing, roughly around $250 to $400 million for a FSRU unit. So the next slide is to say what are the factors we should consider when you are willing to engage and provide a solution of a LNG FSRU ship. So first is to determine the size. So what size of a ship is required, or what type of a unit is required. So lengths vary from 100 to 300 meters. Storage capacity should be between 20,000 to 270,000 cubic meters, and the gas send out reach will be between 50 to 750 MSCFs. And then, then you also have to have the location selection. So what will be the location for this? Because if you have a FSRU, it should be closer to the place where there's a significant demand, and also how the pipelines and other things are being laid. So if it's far away from this, then it will have a significant impact on the cost. So you will have to decide on the location. And also with the location, you also have to decide whether it should be physically being placed near shore or offshore. If it's near shore, then you also have to think of jetty, cost of construction of jetties and breakwater and the other things. If it's far away, then you have to think of the cost of mooring and also the pipeline. So then these are the trade-offs which the party, whoever is investing in this, has to think and to make. Otherwise, these costs will be passed through to the consumers, and we'll end up paying very, very high price on these things. And then I also want to touch on the commercial structures. So one is the gas price determination. Now we have alluded, in the past speakers have alluded, there are a number of ways of determining the gas prices. And so one is based on the index pricing, that is based on the Brent, or whether it's Japan Korea crude markers, or whether it's a Japan crude cocktail, or those are index based. So, or else Henry Hub based, or we can have a hybrid system where you can actually link part of the things to index, and part will be purchased via hub base. So why do we have this? Because if you look at the strategic investment which is happening in the global arena in investments, you will see there's a lot of investments are being spent on building liquefaction facilities, specifically in US. Within the near future, US will become the largest supplier of liquefied natural gas. And also, if you look at their strategies, you will see that they have significant reserves, at least for to fulfill the next 50 years demand, at a break-even cost of less than $3 per MMBTU. And if you were to go a little bit north to Pennsylvania and other areas, they have significant resources that will fulfill the demand for the next 200 years at around $4 per MMBTU. So what it shows is that for the significant period of time in the near future, the Henry Hub or hub-based prices are going to be very, very low and steady. So that's a very, very good thing. The second thing is, if you look at the index linked one, especially to the Brent and others, Brent had been fluctuating very widely. It has been to $40 and it has been to negative. So then if you are going to get it indexed to Brent or any index related ones, that means you will have to explain the fluctuations in this to the customers and also to your policy and decision makers. Why, when the spot market is as very low, why are you paying a premium of 70 to 80% for an index linked price? So this is another important aspect which we have to think. Then the other thing where amongst all these things where it gets a lot of hidden is the purchase quantity. We have to be absolutely sure what is the quantity of purchase what we want if we are going to make a long-term commitment. If we make if you look at the past proposals which landed on the government's table were for large quantities of LNG to be supplied. This is far in excess of what is required. When you do that, what happens is we make commitments. Commitments if it's on a take or pay basis, that means we have to recognize that commitment in our country's balance sheet on the day we sign the agreement. It's not any there. So we know the situation in our country's fiscal status. So we have to be extremely mindful. So basically what we have to, our strategy should be to have the minimum quantities what we require, which will ensure our energy security. And it should be supplemented by stripped cargoes, which says, okay, for the next 6 months, I'll buy X amount of things from a consolidator or for a portfolio player or from a energy company, and then supplement that with the spot cargoes whenever when we see the opportunistic moments to recoup opportunistic moments. Then I want to touch upon the affordability. Now it's well and good. Yes, we make significant savings. He'll alluded to 60 billion rupees and other things. Yes, is it affordable? The question there, the affordability is on the fiscal space limitations. You know that our country is almost, debt to GDP ratio is 90% or so. And we are paying about 70% of our revenue to service our debts and others. And we also, our sovereign debt is selling at roughly around 32 to 40% discount. So given that scenario, we have very little fiscal space. So then if we are going to make a take or pay commitment on any of these quantities and including the cost of FSRU terminal, we have to be very, very careful. Why I say that? So this is a situation, a hypothetical situation saying our committed demand on a take or pay basis is 1 million tons per annum. So that is roughly equivalent to 50 million MMBTUs. And if a price of $10.50 per MMBTU is there, that means our total exposure for a year is $525 million. If we make a commitment for 10 years, that means it's $5.2 billion. If we make a commitment for 10 years, it's 20 years, sorry, it's 10.5 billion. The significance of this is, as I said to you, if we were to sign this agreement on the day before the ink settles, it hits our balance sheet. That means our debt will go by, debt has to absorb it by 10.5 billion if it's a 20-year commitment to buy 1 million tons, right? Which is significant. We can't do that. So therefore, it is not affordable to us. So that is why it is very important before you embark on any of these things to finally see what is the impact on the country's balance sheet, what will it entails. And I also have given you two scenarios. If it's a very wet scenario, which is the least amount of LNG will be consumed, and a normal and a very dry scenario, which is the highest amount of LNG will be consumed, and what will be the impact or what is the best case scenario and what's the worst case scenario, and what will be the impact on our country's balance sheet on those things. So you can have a look at it leisurely. And then I have put it into a graph which shows the orange part is the fiscal exposure under each scenario. And then the other important thing is when you're having a project of this nature, which is running into millions of dollars, and also its impact is felt by the country and its fiscal balance sheet, which is running into billions of dollars, you have to understand and analyze the risk well. If you do not do this, you can regret it leisurely later on because it will break our country. So how you do it is there's a detail at NAPPP or any other agency that we are working in, we actually analyze the risk in detail. So all the risk pertaining to the project is listed, and then say what is the description of the risk and the risk mitigation strategies, and who are the parties who's best able to manage risk is identified, and those mitigation steps are there. So sometimes it's the private party, they can manage it well. Sometimes it's a public party which manages. Sometimes it's both parties who can manage them. So they entail to market risk, then they into political and regulations, development risk, and the financial risk. That's sovereign guarantees, then multilateral bank guarantees, creditworthiness of the LNG off-taker. So if you look at our country, we are about 4 notches down investment grade. And the sub-sovereign authorities or agencies which we have, that's the Ceylon Petroleum Corporation and CEB, who's in this, with the key stakeholders in this project, they have even worse credit rating. So how do you enhance their credit standings if you want to go? Because nobody will commit to these contracts unless there's a significant credit support from an investment graded place. Then the environmental risk, you also should do engineering, procurement and construction risk, social, environmental, health, safety risk, and the country reputation risk. The other one you have to manage is, if we go halfway, half-baked and make a mistake in this, people will think next time when we go with a full-blown good solution, they will not be very serious in bidding for this type of thing. So therefore, we have to have all our resources geared to this and make sure that it is a full-blown proposal and we are very, very serious about it. Then only the serious players will participate in our bid. How much of time do I have? 4 minutes. Oh, okay. So, and then the project structuring. So this is another important part. It stems from the risks, what we have said. The project needs to be structured. Why it needs to be structured when we identify all the parties and others is to say that this is bankable project and people are willing to finance it. And then it will also have agreements and the pricing. It has impact on the pricing and the financing cost. And yeah, so then I have put this one, the tolling and commercial structures, but due to the time constraints, I will skip these two because I want to go into the next one, which is so this is driving factors in choosing FSRU structure. But I think what I want to say is that agreements, please be very, very careful when you are doing these agreements, because it's a culmination of all the technical, financial, legal, commercial aspects are being written into this. And then this is the document which you will take. And this is the document based on a bank or a financial institute will determine whether to give you $100 million, $200 million, or $1 billion of investments or debt. If the documents are not up to their standards, what they will do is they will reject it or they will not give you money. So then you go back to the drawing boards and start redoing all these agreements. So when you look at these agreements, there are LNG sale purchase agreement is there, then facility use agreement is there. That's the terms and conditions for the use of and payment of specific services offered by terminal. And I want to touch upon the sorry, I can't use the. Can I just have a? It is not a touch. No, I don't. I want to use the. Oh, okay, I got it. Sorry, just bear with me for a minute. I want to go to the previous slide, and I just want to. Oh, no, fine. Yeah. So I want to touch upon the general sales or gas sales agreement. So this is one of the key agreements which we will have. There are other agreements also quite critical, but this particular one will say whether there is a take or pay obligation, what is the payment terms, ability of the buyer to withhold payment, or what are on dispute invoices, what constitutes force majeure for the buyer, liability for the natural gas, and then there's a off specification, and then import project liability for delivery shortfalls. And there are a number of other areas. Now I will go into the next slide, which will sort of give you a little bit more background on the bankability of these projects. This is the most important thing in the project, because if you want to do you can do everything about it. You prepare the project, every single thing, and then you take it to the bank. And if the bank says, no, I cannot finance this, then that's back to the drawing board. So you have to prepare for this from the very, very inception. That's why we do such a lot of analysis on the risk. That's why we do such a lot of work on the analysis on the structuring of the thing. That's why we do a lot of things on the agreements, because this is a project financing area. So what it means is you actually ring fence a project, put the assets in, do a special purpose vehicle, and say all the cash flows which is incurred or it is earned by this particular entity should be sufficient to pay the debts, sufficient to pay dividends, sufficient to meet all the taxes, sufficient to meet all the costs relating to this. If it is not, this project is not bankable, nobody will fund it. That's absolutely given, guaranteed. And so why we are emphasizing on the bankability, the project must achieve financial closure. That means you should take it and say that, yes, the banks have agreed, I can financially close it. Therefore, the money is available for me to start the engineering, procurement, and construction activities. To attract financing of this nature, the project must be bankable. I cannot emphasize more on that. The bankability means ability of the special purpose vehicle to service the debts raised by the finance and the construction of the project. So the bankability of the project depends on the ability to generate cash for this project, allocation and mitigation of risk. So it goes back to the slide, how do we mitigate the risk and how do we identify the risk? So allocation of risk should be done, first of all, define and assessed. Then each risk must be allocated to the party who best is suited to bear that risk. Then proper risk allocation reduces the risk premium and improves value for money. Finally, we want is value for money for our customers, who's a general public like you and me. Then many of the risks will flow through. If you mean to say that, yes, there's a risk which I'm unable to bear, I'm unable to bear, that means I will have to pass it on to the consumer. So that means it will come to us. Then bankability, there are 10 critical areas where the bankability will be touched upon. That is market risk. That means what it says is that insufficient demand is there for the LNG or the regasified LNG due to whatever the reason, then that means the revenue stream will be low and then they will not be able to meet the generate sufficient cash. Then sufficiency of the user payment. So if you are doing a power project and if you are going to pass it on to the consumer and they are paying it, and that payment should be sufficient for us to cover the operating costs, service its debts, and provide reasonable returns to the equity investors and pay taxes. And then we also have to mind that these projects cannot be funded within our country because we don't have sufficient capital, developed capital market. So we have to go outside and borrow. When you borrow from outside the country, they are on foreign exchange. So these things are exposed to the foreign exchange risk. Why? Because our income is generated in local currency, but the debts are serviced in foreign exchange. So when there are large amount of debts, how do you manage? So that means your income, what it comes, should be indexed to the foreign exchange or the dollars. Otherwise, you will not have a way of banking, developing a bankable project. Then I'll give 2 minutes. Yeah. Change in law and tax. So there are changes in law and tax, which we will, I mean, as we go on, these are long-term contracts running into 10, 20, 50 years. So we do not know what they will be. But if there are any changes in law, then who's going to bear that change? So there are two different approaches. One is to freeze and say that there is no law and no tax law will affect this project, which is quite not realistic. Or else say there is an economic equilibrium, or that is you restate the whatever the losses or whatever the increase in expenses or whatever the savings that is accrued due a change in law into the previous or the frozen position or the initial position, so that they will be able to service their debts. So these are important things when you come to the drafting of the agreements. These should be there. Then force majeure. This is another area, because if one of the parties are unable to fulfill the conditions set out in the agreement due to unavoidable circumstances beyond their control, then what and how should we do it? So the concession agreement should excuse non-performance of as a result of events reasonably beyond the control of the project company. Force majeure events could be local political, it could be foreign political, or it could be natural reasons. So then those things should be defined very, very clearly, because those are the areas where most of the disputes will occur later on. For commercial purposes, they will say, no, it's a force majeure thing, so therefore I cannot fulfill this. So the dispute resolution is also extremely important in many of these agreements. If you don't have a good dispute resolution mechanism, that means we will end up in having very, very expensive arbitrations. So the concession agreement should provide for both informal disputes as well as the formal dispute resolution, and at a neutral location. That is quite important. When people are coming from another part of the country, they will not want our jurisdiction. They will want some neutral, and also on terms which are UNCITRAL or ICC or similar regimes. Then another one is termination and termination payments. This is very important. We will be very happy to get into a marriage, but if we do not know when we divorce what will be our settlements, that will be a very, very difficult position for the government. So when you are entering into contracts of this nature, we also have to identify what are the termination and the termination payments are. So suppose example, say it's for the non-performance of the buyer or the seller, give the other party to terminate the agreement. So say for example, it's the government of Sri Lanka, for whatever the reason, decided to terminate the contract. Then we should identify what are the payments which has to be made, or the cost of this. One, when you're calculating it, you usually will say it is outstanding debt, interest accrued on debt, and related lender charges. Example, breakage cost, plus the termination cost due under the other contract. So they may have entered into some more contracts, so any termination payments on those, plus shareholder equity less any dividends paid, plus net present value of the future earnings from this transaction. So it's a massive amount of money. And if it's not defined initially in the contract and entered into the contracts as termination payments, later on you can regret leisurely, because the government will have to pay all those things, or any party who enters this. Then other one which I want to touch upon is the credit support. I touched on this and say that our sovereign debts is 4 notches down investment grade, and our sub-sovereign debts relating to CPC and CB are even worse than that. Therefore, if you are going to enter into any of these things, people will ask for credit support. There's no two things about it. Don't think that they will not. So depending on the creditworthiness of the authority, credit support will be required. A contracting authority, say it's CEP or CPC or the government of Sri Lanka, without investment grade rating would require credit support to achieve reasonable debt terms. People will give you. So it's like going into a loan shark and asking, they will give you at a massive interest rate. So that is not feasible in this contract. So what are the ways that we can do? We can have letters of comfort, sovereign guarantees, which are again guaranteed by other things, put or call options, liquidity or letterhead, liquidity letters of credit, and liquidity escrow accounts. So one second, and then interface risk, that is if the power plants come in before the FSRU, then it's a cost, and if the FSRU comes in before the power plant, then it's a cost. So it's both ways, it has to be matched, and how you do it. And then my final slide, I want to say, started with the strategic intent to introduce LNG. Our goal should be to monetize our hydrocarbon resources soon, because oil peak is approaching very near to us. We must set the stage to attract much needed investments to this process, which is to monetize hydrocarbon resources, and introduce LNG as a transient solution to develop the downstream industry structures. Thereby, we will be able to attract the much needed investments to do our monetization activities. If we fail to identify the risk and allocate the risk and mitigate the risk, and develop the most suitable structure for LNG procurement strategy, volume commitment, etc., the results are disastrous, running into billions of dollars. If we fail to consider adequate due diligence in technical, financial, commercial, legal issues, we will not have a bankable LNG, no matter what we have done. It will be not financeable. Our project may, and also it will delay the project substantially. Even after signing the commercial closure, we will not be able to do that. Therefore, my advice to you is to consider all options, do a proper due diligence, identify risk, resolve legal and bankable issues, check the affordability of the proposed solution, and above all, have the best professional help available to you at all times. Thank you.